Netflix is down 46% from the highs. Celsius has lost half of its value this year. And a stock that nobody's heard about has jumped 10% overnight. Wallstreet has completely missed the mark on these, and trust me, you're going to want to stick around because I'm going to give you the hidden details and the data behind these 3 companies so you can see which one is the best investment for you. So 3 stocks, 3 completely different stories, all making moves this week. Let's start with the biggest name, Netflix. So Netflix is down 46 from its 52-week highs, trading around $77 to $78. So you must be wondering, well, Netflix must be a bad company now. But let's see and take a look at what's actually dropping the stock price. Now, what seems to be the biggest reason for the stock dropping? And when we take a look at the data, it shows that because interest rates are rising, causing the stock valuation to decompress to where it's losing a valuation, and well, not losing a valuation, but the valuation is going down on the company, making the stock price cheaper. Now, the company is still cash positive, which you would think would be a green light for the company. However, there has been a notable amount of insider selling in Netflix, which is kind of scary and can spook the market a little bit. However, unfortunately, the insider selling also comes from the CEO who sold $2 million worth of stock, which is a small amount, but it's still an amount nonetheless. So that can kind of spook people when the own CEO is taking profits, but he could just be doing this to pay bills. Who knows? However, there is a contradiction that makes the stock a very appealing opportunity. A Seeking Alpha analyst stated that the Netflix PE ratio is now down to 20 times forward earnings, which is extremely low, right? So you might be buying the dip here if you were to buy now. But what makes it even more exciting is Netflix throughout its entire history. Think of the days from it's just starting out to now, from when it went from CDs to the virtual Netflix that you know today. Think about that in the sense that Netflix has always been able to adapt, and now they're also adding games. If you've been on Netflix recently, I'm sure you've seen the fun family games that they have, and they're always adding things to the Netflix browsing menu. Now, you might be worried because you go, oh, Netflix is just a subscription-based model where they're not going to be able to make more profit. The profit's going to stunt the growth. That's where you're wrong. Netflix has so many different little levers. They're just now getting into the advertising business. If you noticed, one of their subscription models is cheaper, but it also includes ads. So they're introducing the subscription model with ads, which overall, they can pull that lever whenever they want to, and that can bring in more cash flow, which is why they are still cash positive, is because they're able to pull so many different levers, such as the subscription model. And on top of that, they're always able to slightly upcharge on the subscription model, and no one's gonna unsubscribe if they move it up $1 a month, once every 2 years or so, right? It's those little bumps that are going to increase the growth of the company, and people who have Netflix are not going anywhere. So Netflix will slowly be able to increase prices and make money with their ad business, and I think it's going to increase revenue like you've never seen before, which makes it a very intriguing buy for me. So I personally loaded up about a good chunk of my portfolio into Netflix. I bought it around $75, but I think if you bought it now, even at $78 as we're filming this video, it is still a really good buy and a good opportunity. Not financial advice, I do not know your personal situation, I have to say that, but it is very intriguing. I think you should take a look at it. Sorry for the car in the background. I'm at a USC dorm, so the noise is what it is. Alright, our next stock, which is Celsius Holdings, CELH. Should have done the ticker symbol for Netflix, but I'll just share it with you right now. It's NFLX. Go look it up on your brokerage account. So, we're on Celsius. So Celsius, CELH. What is the bear? What is the bull case? Why did I buy thousands of dollars worth of shares? Let me tell you. But first, let me tell you why the stock dropped. Okay. So, earnings expectations have dropped. The main umbrella company that Celsius is known to be has dropped, and they're lowering their earnings, and they're doing a little bit poorer on their earnings report. They're not making as much money as they had thought, and they're kind of tanking a little bit. But, however, the Rockstar and the Alani companies, which are all owned by the umbrella brand of Celsius, are actually performing quite well. And those are doing better than expected. So why is the stock down still? It's mainly that people are worried that this downtrend of Celsius stock is going to keep declining, which I just think is not true. And if you look at the earnings, there was a couple one-time fees that they had that are just short-term stuff that it shunt the growth. But that's not the shunt. stunted the growth. But that's not the bigger picture here. You're going to want to look at the earnings. And what do the earnings have to say? If you go look at projected earnings for what they have, I'll see if I can find a chart to pull up. This is just a short dip in the market, and I think that's why if you look at the stock price, you've seen such a rapid bounce back to the upside, is because the real investors who already done research, who got into the stock early, like I did at $24 a share, it's like almost 30, it's $30 right now, already know and see the price coming to bounce back. They know that it's a short-term loss. And then on top of that, if you look at the earnings of it, this is a totally different company, but companies like AT&T, T-Mobile, who never have like exciting movement in the market, their earnings are flat, like a line, a super flat line, bro. If you look at companies like AT&T and T-Mobile, their PE ratio is currently higher than Celsius by the time of this recording, which makes Celsius a really, really appealing buy, which is why I loaded up so much money into Celsius. It's like not even funny, and my average cost is like $24, like $24.30. So I got in at a good price. Another cool thing, and I've done so much research on this stock, probably one of my most researched stocks of all time. If you look at it, Celsius's fair valuation currently sits at $76. The stock is currently trading at $30, meaning that there is like a 60-something% upside from here, 60-something%. So just think about that. And then even better, the lowest analyst expectation is $39. The lowest, the most bearish person. The yearly price target is $39, and the stock sits at $30. The reason it is trading lower is, as I've stated before, it's simply trading lower because of the earnings, and people got spooked for a short time. That's that. Okay, there's something else very important that I must add that people are also, I think, this makes the stock a little bit more bullish, but some people don't like it. The Rockstar CEO came in and bought $30 million worth of Celsius shares, upping his stake to like 12% or something. I'll put the actual numbers on the screen. That made people a little bullish, not bearish. It made people bullish because he said he is disappointed in the Celsius's overall, how they're handling things and just how everything's going over there. And he wants to take over and put himself as the new Celsius CEO. Now, whether you like that or not, it is true that Celsius is doing a poor job of rebounding. But if you look at the fundamentals, this is a short-term drop in a pretty good stock market, and it's just trading at ridiculously cheap evaluations. Like, why wouldn't I pick it up? But don't expect, just because I made like 20% on Celsius in like 2 weeks or like 10 trading days, just because I made that type of money fast like that, and because I got in crazy early, and I had a little bit of luck with the timing of when the CEO, the news released about the CEO spending $300 million and acquiring Celsius shares, don't expect this one to just bounce, okay? It might have its up and down days, just like any other stock, but trust me, in the long run, this is gonna be a buy that you're gonna look back and you're like, man, I wish I had bought some of that stock. If you made it this far, I want to take a quick gap in the video just to say that I'm a solo entrepreneur and a solo YouTuber who's doing this in the dorm of my college at USC, University of South Carolina. And I just want to make sure that if you haven't hit the subscribe button, go ahead and do that for me. It helps out a ton. I'm trying to see if I can make YouTube a career, and I just love sharing this free advice for you. So if you want to continue to see free advice, please leave a like and make sure to subscribe, and let's get into the next stock, which is Honest. So, Honest, ticker symbol HNST. Now, what is this stock if you've never heard of it, and why am I talking about it today? Well, people used to think that this stock was the $3 chuck, right? It was $3 about a little while ago, and so now it's it's been raised to $5. I was trying to think of the exact price. Now, The quarterly earnings for Q2 just came out like a couple weeks ago, and they beat earnings by 0.02 cents. Now you're like, oh, that's a small amount. No, it's not. This is quite the small cap company. So they beat revenue 100%, which caused the shares to surge 7%. And then after hours and some other news, it surged like even higher to like 10 or 12%. So the net income for the company this quarter was around $10 million, okay? And on top of that, they're initiating a buyback program, a $25 million share buyback program, which should get you really excited about owning the Honest Company. And what's even better, okay? As far as the 2026 revenue guidance was bumped to $319 million from its prior $306 million, which for a company of that size, that is quite the substantial raise in the guidance. And the company is loaded with cash. The company currently has $105 million just sitting there in cash, ready to deposit, which is why they are doing the $25 million share buybacks, which, like I just said, should get you excited because they're buying back shares of the company because they have so much cash, they don't really know what to do with it. And when they buy back shares, guess what the stock price does? It goes up. And so on top of that, they just have great earnings, they keep beating guidances, and they're buying back shares. It just looks like such a good company. Why would I not buy it? And I know it's a small cap, and small caps scare certain people. There is a group for sure that doesn't want to buy small cap invest. Gosh. And no, I could see why someone might be scared of buying the Honest Company, which is why we've listed other companies in this video that you could also go invest in. But honestly, I would put, if I had $10,000, this is where I would put it. I would start off by putting $3,000 into Netflix. Then I would take Celsius and I would put $5,000 on Celsius. And then for Honest, I would do $2,000 because that one's obviously a lot smaller. But Celsius has so much upside, and Netflix is just such a long-term perspective gain. And then Honest is like a little risky because it's small cap, but it's just I don't see any possibility of them going down, having lower guidance, the earnings going bad, because they have so much cash, they're buying back shares, and the company's earnings are just great. Like I can't complain about anything in the company's earnings, and the earnings call was great as well. So at the end of the day, those are the stocks. If you haven't hit the subscribe already, please do so and leave a like. I love making these videos. I'll see you in the next one. If you want to learn how to invest your first $100, click on the video right here.